So I've spent half of my career disenfranchising people, millions and millions of people, including people like my parents, from accessing the modern economy. You know, my parents came to this country, I'm the son of immigrants, they came to this country in search of economic opportunity. And my elder brother and I saw firsthand how vital and important financial access was to them, to start and grow their businesses, to send us to the best schools, importantly, to send money home to their friends and family who really needed it. And part of that was they instilling into us a very, very strong sense of financial education, and not only to ensure that we avoided exploitation, but also that we were put on a solid footing with strong financial behaviors, responsible financial behaviors. But what my parents didn't understand or realize at the time was I was going to make it very hard for them to accomplish their own financial goals. And it wasn't because I would outspend my budget or misuse a credit card or be so generally undisciplined that they need to send me to military school. They did send me to military school. No, it was well into my career, starting a family, gainfully employed, where I was given some opportunity to do some meaningful work, but true disenfranchisement would start then. After the tragic events of 9/11, I was given the opportunity to join the US Treasury Department, to join our counterterrorism fight, only to use economics and finance to combat illicit threats. See, we realized that the financial and commercial system, that which we all thrive on, that is necessary for our everyday lives, is equally important to criminals, right? To build and support a terrorist organization, to launder the funds of a drug trafficker or weapons proliferator, to hide the assets of a corrupt dictator. But their dependence on that system also meant we could find ways to thwart them by attacking and shutting down the networks and financial infrastructure that they need to sustain themselves. And we had a lot of really early good traction, a lot of successes. We identified and sanctioned individuals and companies that were facilitating terrorism globally. We were freezing hundreds of millions of dollars associated with these networks. We, all the while, strengthening global anti-money laundering and compliance frameworks to make it harder, riskier, costlier for bad guys to do their work. But we were also creating a system and a set of circumstances that would make it incredibly difficult for well-intentioned, legitimate, everyday transactions to transpire. See, as a result of rising global compliance and regulatory needs and requirements, hundreds of millions of people were being negatively impacted, and it was having a disproportionate impact on certain types of customers, in particular, poor countries, low, moderate income individuals, certain types of entities like charities, money service businesses, correspondent banks, all thought to be more vulnerable to terrorist financing exploitation. Or certain kinds of transactions, global remittances, international money transfers, because they too were potentially vulnerable to exploitation by illicit actors. We were spending so much time looking for these bad guys that we were forgetting about the national security implications of financial exclusion. See, as a result of growing financial compliance burdens, many banks began the process of de-risking. In other words, denying or cutting off access to a number of very legitimate, well-intentioned individuals in the financial system. And this is having gross consequences on an international level. And this is happening for two reasons. One, because compliance and risk management is expensive, right? As a result of increased compliance, not only from the US, but globally, we have seen the number of risk and compliance measures in the regulatory environment scale dramatically. This is what it looks like just from 2000 to 2016. Coupled with the fact that our growing financial regulatory blueprint, this is how we manage the financial system, an increase of enforcement actions where just the global banks alone received over $320 billion in fines through last year for negligence or lack of financial compliance controls. This is on top of risk and compliance departments that are over 20% of the operating budget of most banks. So this is a very, very, very risky endeavor, but a very expensive endeavor. But de-risking is having a massive, massive negative consequence for the globe. Do you realize that in the United States alone, more than 25% are either unbanked or underbanked. Globally, that's 2.5 to 3.5 billion people. As hundreds of millions of international money transfers get frozen, you're talking a vital line for assistance to poor countries. At $440 billion yearly of global remittance flows, that's 3 times foreign aid. Many poor countries rely on this for vital financial assistance. My own parents and many of their friends started going to their Indian grocers to send money home. Unreliable? Maybe, but certainly efficient for them when other channels get knocked off. Institutions were getting blocked out. Correspondent banks were starting to lose access to their Western and US counterparts. Even charities, friends of mine that were working Ebola relief in Africa or vital humanitarian natural disaster relief in South and Southeast Asia and the Caribbean most recently, weeks and weeks of payment delays and many charities just unable to establish a bank account because of increased scrutiny. And what happens is when otherwise economic actors are denied formal services, they go to alternatives, payday lenders, check cashers, loan sharks. These guys are performing a vital service, but often are costly and serve to exacerbate poor financial decisions, which underscores an even bigger epidemic that we're facing, which is the destruction of our financial health. Right? Do you realize that in this country, almost 50% of Americans cannot cope with an unexpected expense of $400 or more? Almost 2/3 of Americans struggle financially with just basic budgeting and expense management. Financial health is just as important as physical health. But the fact is, to a traditional bank, if you're low income, you're high risk. If you have volatile income, you're high risk. If you're new to the financial system, you're high risk. If you're sending money to and from an international jurisdiction, a frontier market, especially one considered high risk, you are high risk. We're spending all this time looking at the financial implications, the national security implications of money laundering, terrorist financing, that we're actually failing to understand the national security implications of financial exclusion. Now, everyone understands the term a needle in a haystack. We focus so much on finding the illicit needles that we're forgetting about the importance of the hay itself. Not only in terms of the disruption to well-intentioned, well-meaning, legitimate transfers, but also the richness of data and information that those legitimate transfers represent. There are solutions. First off, we can't see regulation only as a burden. It can also be a value-added asset, right? All anti-money laundering and compliance programs come down to one question. Do you know your customer? What their financial intents are, what their financial needs are, what their source of funds are, what their expectations are? These are the exact same questions to proactively serve clients in need. And yet, the very information that global compliance departments collect on you and know your customer due diligence often sits unleveraged in those compliance departments unused. The very analytics processes we use to analyze illicit financial crime can be used to understand credit profiles and legitimate need, where we actually address actual risk, not perceived risk. We need stronger and smarter risk management, not simply more compliance management. Number 2, we need to take a whole systems approach and look at positive rewards, not just punitive measures, to provide for financial inclusion. And that whole systems approach means everyone has a role here. Regulators need to encourage positive financial innovation with measured risk. While the US regulators are somewhat risk-averse, UK has set up a financial industry sandbox, bringing banks and innovators together to explore new technologies. Some of those technologies in mobile communications and digital ID can break down the barriers for access and perform vital customer due diligence at the same time. Technologies like the blockchain can build surveillance and trust in the system while protecting privacy and autonomy at the same time. Policymakers need to look at community-based financial engagement as a driver to that access, not simply look to cut them. Small business lending, community development, financial institutions are often the best positioned to understand local needs and assess local risk. And financial institutions need to look at community-based groups in social services, low-income housing, workforce development as financial access points, because those groups are often the ones that have the highest trust in communities, especially when trust in banks is at an all-time low and understanding is also low. And finally, educators, schools need to build financial education into the curricula. Do you understand that 5 out of 50 states in this country actually require one course for a graduating senior? Right? And there's studies upon studies that show that there's a direct link between the level of education and the sustainability of positive financial responsibility. But we send our folks out into the community financially illiterate. As a friend of mine said, knowledge without access may be harmless, but access without knowledge is destructive. Just look at the recent mortgage crisis. And you might be asking me, after all this destruction, what am I doing? I'm doing my penance. And my penance is an effort we call FinCentive Capital, and we're trying to put some of these strategies to play, bringing new technologies and analytics and the blockchain, and combining them with traditional financial services to break down barriers, bring down costs, and to bring down friction, but enhance security and transparency at the same time. We're linking community-based action groups with traditional financial services through technology to drive better inclusion more cost-effectively. And we're trying to enhance risk management systems to do more on the service side, not just the compliance side. The net result should be greater financial access and inclusion, more resilient households and communities, and a stronger, more secure financial system. Prepping for this event, I was reminded that President Kennedy was faced with amazingly unique geopolitical challenges. And in his wisdom, he understood that grassroots development was vital to our national security. It was under his leadership that the Peace Corps was born. If we understand that our day-to-day lives require financial access and engagement and education, then we have to see that engagement as a fundamental human right, which means that a denial of it should not be judged or conditioned on the perception of one's risk or affiliation. Today, the lines of division are growing, and they're exacerbated by the fact that people are struggling to meet their everyday financial needs. And yet, we continue to have this debate of trading away community development goals, community development tools, in order to protect our national security. But I implore you to look at financial inclusion as not simply a noteworthy social development goal, but a vital tool to our national and international security. And that's an idea I think is worth spreading. Thank you.